Iron Financial. You know the mission here. We forge stronger portfolios by cutting right through the market noise. We stress test the numbers that actually matter. We don't deal in hype. We build on a foundation of strength. Today, we're putting Bank of Hawaii on the anvil. Their latest earnings report just hit the street, and frankly, the headline numbers have got everyone talking. Our job, as always, is to figure out if this is a truly solid structure or just a pretty facade that's going to crumble under the first sign of pressure. Let's get in. And this is the number that started it all. Bank of Hawaii, ticker BOH, just dropped a bombshell, a 32.2% year-over-year explosion in net income. Now look, in this market environment, a 32% pop in profit, that doesn't just happen by accident. That is a massive flare shooting up into the sky, and we have to know what it's signaling. Is it a beacon showing us a real opportunity, or is it a warning flare telling us to stay away from a trap? Whoa, hold on a second. 32% is a monster number, I'm not going to argue that, but come on, we've seen this movie before. The market is an absolute graveyard of companies that post one single spectacular quarter and then just fall right off a cliff. So the real question, the only question that matters, is this a sign of genuine, sustainable, structural strength in their core business, or is this just a temporary sugar high? You know, a flash in the pan caused by some market weirdness that's going to vanish as soon as things get back to normal. We need to know if the foundation here is built on rock or on sand. Exactly right, and that is precisely our battle plan for today. We are going to deconstruct this earnings report piece by painstaking piece. First, we'll verify those headline numbers. Did they really deliver a solid beat? Then, we're popping the hood and going deep inside the profit engine to figure out how they're actually generating this cash. After that, we put the bedrock of any bank, its credit quality, through a serious stress test. From there, we'll check the overhead. Are they controlling costs or just letting them run wild? Then we'll inspect the balance sheet to see if it's really built like a fortress. And only then, after all that, we'll deliver the official Iron Financial verdict. Time to get to work. Okay, first things first. Let's start at the top. Section 1, was this actually a solid earnings beat? These are the headline figures that are grabbing all the attention and driving that initial market reaction. So before we go any deeper, let's just make sure the hype is actually justified by the cold, hard data. And I've got to say, the numbers do not lie. Take a look at this. Net income, like we said, is up 32.2% year over year, hitting $53.3 million. That is some serious heavy lifting. But it's not just the profit line. Diluted earnings per share, or EPS, what shareholders actually care about, is up a massive 29%. And here's the best part. It's all built on a solid 12.2% increase in total revenue. This isn't some financial trickery where they just cut costs to the bone to make the profit number look good. This is real, authentic, top-line growth that's flowing directly to the bottom line. It's an undeniably solid beat. No two ways about it. Okay, fine. The beat is confirmed, the numbers are big, they're real. But this right here, this is where my skepticism really starts to kick in. Return on equity jumped from 11.5% to almost 14%. That's really impressive. It means they're getting way more efficient at turning every dollar of shareholder money into pure profit. But my question hasn't changed. How? How are they doing it? Are they suddenly taking on a boatload of new risk? Did they benefit from some one-time sale or a lucky break? I don't care about the what. I care about the how. Where is this profit actually coming from? Is the core business, the actual day-to-day operation, getting stronger, or is this just some fancy financial engineering? And that is the perfect question. It brings us directly to the heart of this entire analysis. It is absolutely time to open the hood, get our hands dirty, and inspect the core engine of this bank. Because for any financial institution, that engine is one thing and one thing only: its ability to earn more money on its loans and investments than it has to pay out on its deposits. We are talking about net interest income and, the metric that truly matters, net interest margin. Right. Forget every other metric, all the other noise for just a second. If you want to understand a bank's fundamental ability to generate raw, repeatable, quarter-after-quarter profit, you look at one thing. Its net interest margin, or NIM for short. This single number tells you almost everything you need to know about the health, the power, and the efficiency of its core lending business. It is the primary driver of earnings, period. All right, let's break that down. Assume not everyone watching lives and breathes financial statements. What is NIM in plain English? Give us an analogy. Of course, the simplest way to think about it is this. A bank's assets, all its loans and investments, that's its engine. The interest it earns on those assets is the power that engine produces. Now, the interest it has to pay out to its depositors, that's the fuel the engine consumes. So the net interest margin, the NIM, is basically the horsepower rating. It's a pure measure of how efficiently that engine can convert fuel into raw forward motion. A wider margin, a higher NIM, means you have a more powerful, more profitable engine. It's really that simple. Now, here's what makes this so compelling. This isn't a one-time fluke. This isn't some one-quarter wonder that they got lucky. Bank of Hawaii has now posted count them, 6 consecutive quarters where their net interest margin has expanded. This isn't a sudden jolt of power. This is a consistent, deliberate, methodical strengthening of their core profit engine over a year and a half. That's not a sugar high. That is a powerful structural trend. And this chart just lays it out perfectly. You can see the trend right here with your own eyes. Go back a year ago, third quarter of 2024, their NIM was sitting at 2.18%. Then you look at last quarter, it was up to 2.39%. And now, this quarter, it just hit 2.46%. That steady, relentless upward march is the entire foundation of this incredible earnings beat. This is the how we were looking for. They are systematically getting more profitable on every single dollar they manage. This is the source of that 32% profit jump. So let's get into the mechanics. How are they actually pulling this off? Well, it's really a 4-part story, and it's beautiful in its simplicity. First, they're simply earning higher yields on their new loans and assets. Pretty straightforward. Second, and this is absolutely crucial, their old, lower-yielding fixed-rate assets are maturing, and they're able to reinvest that cash at today's much higher rates. It's like systematically replacing an old gas-guzzling motor with a brand-new high-efficiency one. Third, their cost of fuel, the interest they have to pay on deposits, has actually gone down compared to this time last year. And fourth, they have a stable and growing supply of that cheap fuel, with total deposits on the rise, more money coming in at a lower cost, going out at a higher rate of return. That, my friends, is the textbook formula for a powerful profit engine. Okay, you've sold me on the engine. I get it. It's powerful, it's efficient, and it's clearly getting stronger every single quarter. I'm with you. But a powerful engine is completely and utterly useless if the chassis it's bolted to cracks under pressure. And for a bank, the chassis is its loan book. So what about the quality of these loans they're making? Are they juicing their returns by lending money to risky borrowers who are going to default? Are we going to see this whole beautiful machine fall apart the second the economy hits a pothole? Let's talk about the bedrock. Let's talk about credit quality. Well, management is certainly not lacking in confidence. The chairman and CEO, Peter Ho, he came right out in the press release and used the word exceptional to describe their credit quality. Now, that's a very bold claim. In the world of banking, exceptional is an incredibly high bar to clear. So you know what we're going to do? We're going to put that claim to the test with the hard data. We don't trade on quotes. We trade on facts. Okay, so the first piece of evidence is this chart of non-performing assets, or NPAs. Let's be really simple here. These are the loans that are seriously past due. These are the loans that are on the verge of going into default. This is the number that keeps bankers awake at night staring at the ceiling. And as you can clearly see, BOH's NPAs as a percentage of their total loans have been in a steady, beautiful decline. A year ago, it was 0.14%, and today it's sitting at just 0.12%. To be clear, that is an incredibly small number. It indicates a very healthy, very disciplined, and very well-managed loan portfolio. We are not seeing any cracks appear here. Wow. Okay. Now this is where that exceptional claim actually starts to look like an understatement. Look at that net charge-offs chart on the left. A charge-off is a loan that the bank has completely given up on ever collecting. It's a total loss, and their rate is 0.07%. Let that sink in. 0.07. That means for every $10,000 this bank lends out, they are losing a grand total of $7 to bad loans. It's practically zero. It is a rounding error. They are losing virtually nothing. And then you look to the right, and delinquencies, people who are just late on their payments, are also going down. This isn't just good credit quality. This is pristine. The bedrock here is solid granite. The CEO's claim is 100% validated by the data. All right, I concede, I'm convinced. The engine is powerful and the foundation is rock solid. That is a seriously potent combination. But there is one more piece to this puzzle we have to look at. A car can have a great engine and a strong chassis, but if the maintenance costs are totally out of control, it's still a bad investment. So let's pivot and look at the expense line. Is this bank actually keeping a tight lid on costs, or is all this strong revenue growth just masking a bloated, inefficient operation? Is the engine running efficiently, or is it leaking oil everywhere? And this is where we find our first potential crack in the armor. Because on the surface, these numbers don't look great. Non-interest expense, which is basically just the bank's overhead, everything from salaries to software to rent, it came in at $112.4 million. That's up almost 5% from the same quarter last year.
Now remember, revenue grew by 12%, so they're still well ahead. But expenses growing at nearly 5% is still a headwind, and it's something we have to investigate. So what is behind this increase? Okay, digging into the details here provides some absolutely critical context. The main driver of the increase is higher salaries and benefits, which, you could argue, is an investment in their people. But more importantly, this quarter's number includes a one-off, non-recurring servants-related charge of $2.1 million. Now, if you pull that out, if you adjust for that one-time item, the year-over-year expense growth drops to a much more modest and manageable 3.0%. So while management talks a good game about prudent expense management, a 3% underlying growth rate is fine, it's reasonable, but it's not exceptional. It's not a glaring red flag, but it's certainly not a green one either. This is the metric we'll be watching like a hawk in the quarters to come.
All right, let's move to our final, and in today's market environment, maybe the most critical test of all. We've established the engine is strong, we've established the chassis is durable. Now we need to check the armor plating. We're talking about the bank's capital reserves. That's the financial cushion, the war chest it is built up to absorb unexpected losses. The big question is, can this bank withstand a serious economic storm? And honestly, this slide says everything you need to know. Those gray lines you see near the bottom of the chart, those represent the absolute minimum capital levels required by federal regulators just to be considered well capitalized. Now look at Bank of Hawaii's actual capital levels, those towering blue and green bars. They are not just clearing those minimums, they are absolutely dwarfing them. They have built up a massive, almost excessive safety buffer. This is what we at Iron Financial call a fortress balance sheet. It is overcapitalized on purpose. It is built to withstand severe economic shocks. Whatever the market throws at it next, this bank has the financial armor to take the hit and keep on going. Okay, we've taken the machine apart, we've inspected every single component, we've stress tested all the critical systems, we've looked at the engine, the chassis, the operational efficiency, and the armor. Now it's time. Time to put all the pieces back together and deliver the final verdict based on this deep dive analysis. Was that 32% profit jump a sign of a real, tangible opportunity, or was it just a trap? So here it is, the final scorecard. And let's be honest, the structural strengths here are overwhelming. On one side, you have a sixth straight quarter of net interest margin expansion. That is a powerful and accelerating profit engine. You have what we've called pristine credit quality, with non-performing assets and charge-offs that are so low they're almost non-existent. The foundation is absolutely rock solid. You have a fortress balance sheet with capital levels far, far above what's required, and it's all being fueled by a stable and growing deposit base. The only potential crack we could find was that modest rise in non-interest expenses. It's manageable for now, but it's a yellow flag that requires monitoring. The verdict, though, is clear. This earnings beat was not a fluke. It is built on a solid, durable, and strengthening foundation. I have to agree. The case is incredibly compelling. They passed every single stress test we threw at them today. The business is fundamentally, structurally strong. But I'll leave our viewers with this one final thought to chew on. We've established the engine is powerful and the chassis is strong. The whole operation is built for high performance. But the key challenge for management going forward, the real test, will be controlling those operating costs, the fuel and the maintenance of this financial machine. If they can maintain that same level of discipline on the expense line that they've shown on the credit line, there is no reason to believe this powerful performance can't continue. That's the variable to watch, and that will be what determines if this is just a good company or if it becomes a truly great one.